I've seen founders lose millions at exit, lose control of their board, and even lose their own company because they didn't understand what they were signing at the term sheet stage. As a startup lawyer who's negotiated hundreds of these deals, here's what I can tell you. Once you sign a term sheet, the deal is about 90% done. That means every number, every right, and every clause on that term sheet is what you're agreeing to for the next 5 to 10 years of your company's life. So in this video, I'll walk you through everything you need to know about exactly what's in a term sheet so you know exactly what to push back on before you sign. So let's dive in. What's a term sheet? A term sheet is simply a summary of the key deal terms for an investment into your startup. It covers valuation, the investment amount, the rights the investor gets, and whether they get a board seat, and a lot more that we're about to go over. And it's the document that sets the foundation for everything that comes after. Now here's the part you need to understand when it comes to how you approach signing a term sheet. Term sheets are usually non-binding, except for a few terms, which means if the investor walks away after signing, you generally can't sue them for the money. So on paper, nothing is really legally enforceable, as I mentioned, except for a few terms at this stage. But that's the legal definition, and it's not how it actually plays out. Once a term sheet is signed, the deal is about 90% done. It's rare for an investor to back out after signing, but it does happen. So don't count your money until it's actually wired to your account. The term sheet is super important because all the final investment documents do is just formalize what you already agreed to in the term sheet. That means the investment amount, your ownership percentage, liquidation preference, board seats, voting rights, they all get locked in at this stage. So if you sign a term sheet with bad terms and then bring in a lawyer at the closing stage to try and renegotiate, you've already lost leverage to do that. The investor will fight any changes because you already agreed to the terms and they have every reason to fight. So with that context in mind, there are two categories of terms you need to understand inside every term sheet. The economic terms, which decide who gets paid what and when, and then the control terms, which decide who actually makes the decisions in your company going forward. Let's start with the economics. The first economic term is valuation, and this is what prices your shares. You and the investor negotiate this, usually based on comparable companies in your space, plus your stage and your metrics. The valuation at which you raise directly determines how much of your company you're giving away for the investment. Next is the liquidation preference, and this is one of the most important terms in the entire document. When investors put money into your company, they get preferred shares, and those shares come with a liquidation preference attached to them. So what the liquidation preference does is it gives investors the right to get paid first when the company sells, before common shareholders like you and your employees see a single dollar. For example, a 1x liquidation preference means the investor gets their investment back before anyone else gets paid. So if they invested 10 million, they get that 10 million back before anyone else gets any money at all. A 2x liquidation preference means they get double their investment back first. So on a $10 million check, that means they'd take 20 million off the top. With that said, this is where things can get really painful years later. So when you're staring at a liquidation preference on a term sheet, that number tells you how much of your eventual exit goes to investors before you see anything. And the exact type of liquidation preference matters too, which is where participating versus non-participating preferred shares come in. With non-participating preferred, the investor has to pick one of two things at exit. Either they take their liquidation preference or they convert their shares to common stock and take their ownership percentage of the sale, but they can't do both. With participating preferred, sometimes called the double dip, the investor takes their liquidation preference first and then also takes their ownership percentage of whatever's left over. Now, the good thing is that participating preferred is pretty rare these days. Only 6.2% of deals in 2024 had participating preferred, and only 8% of deals had liquidation preferences over 1x. So if an investor comes at you with participating preferred, you should push back hard to try to get it off the term sheet. If they won't budge, you can push for a cap, which limits how much extra the investor can take on top of their liquidation preference. So the double dip has a ceiling instead of paying out forever. Then there's the option pool, which is where one of the most common founder mistakes happens. The option pool is equity that you set aside for future employees, advisors, and consultants. And investors will typically ask you to create this pool before they invest, usually something like 10 to 20% of your company. And that pool comes out of your ownership, not the investors. So if they ask for a 20% pool, you're taking an extra hit before their money even hits your bank account. And how this typically is written into the term sheet is that it's a post-money pool, meaning it cuts into your pre-money valuation. So if you're raising $5 million at a $20 million pre-money valuation, and the investor requires a 10% post-money option pool, you're essentially getting a 17.5 pre-money valuation. This is how you calculate your effective valuation. Now, the way you fight back on this is to walk into the negotiation with a hiring plan. You do this by building out your org chart for the next 12 to 18 months with equity assigned to each role that you actually need to fill. This way, you can show the investor that based on your hiring plan, you only need a 10% option pool, not 20%, and you walk them through the math. And it's much harder for the investor to argue with concrete numbers from your own hiring plan. By the way, I've negotiated hundreds of these term sheets. So if you're already looking at one right now and you want me to personally help you out with your term sheet, click the first link in the description and book a free consultation with me. Anyway, back to the video. Control terms. So that's the money side of a term sheet. But the other half is about control, which is who actually makes the decisions in your company going forward. And the first control term is the board composition. This is where you figure out how many seats the board has, and more importantly, who gets to appoint each board seat. At incorporation, typically your board is going to consist of you, the founder, and if there's a co-founder, then your co-founder as well. You definitely don't want to be giving away board seats at the angel or pre-seed stage, and even at seed stage, you really shouldn't be giving board seats or veto rights. See, founders think that loss of control of the company happens because of dilution, but most founders don't realize that where losing control of the company usually begins is with your board. It's the first way that founders lose control of their company. Now at Series A, your Series A investor is going to want board seats, but you should also push to have an independent advisor on your board to break up ties and balance out the board between founders and investors. Board decisions are going to be including things like hiring and firing the CEO, approving budgets, and approving future fundraisers, which by no means are things to take lightly. From there are also protective provisions, which are decisions that require investor approval before the company can make them. Different protective provisions include issuing new shares or classes of new shares, mergers, acquisitions, or changes of control, selling the company assets, liquidation, taking on debt above a certain threshold, increasing the option pool beyond a certain size, and changing the size or the composition of the board. A common horror story here is where a founder wants to sell their company, but investors block the acquisition because it doesn't match the investor's expectations for an exit, or vice versa. Investors force the founder to sell the company despite the fact that the founder doesn't want to sell. So even if you control the board, the investor can block any of these decisions on their own. This list tends to grow during negotiation, so you want to push back on anything that doesn't need to be there. All right, let's move on to information rights. These give the investor the right to inspect your financials and operations on a regular basis. Usually, that's quarterly or annual financial statements. Sometimes monthly if the investor is a larger institutional fund with reporting obligations to their own investors. Now, you want to keep these reasonable and tied to specific intervals, not something vague, like whenever the investor requests it. So make sure you always tie information rights to a fixed schedule like quarterly or annual reports, and never agree to open-ended requests. Now, the last control term you need to know about is the right of first refusal and co-sale agreement. This is going to restrict how founders can sell their shares, so it protects investors from founders cashing out early. From your perspective as the founder, it also restricts your liquidity, so you want to make sure you understand what it allows and what it doesn't. How to negotiate a term sheet. Now that you know what's actually inside a term sheet, let's talk about how to negotiate one. The single biggest factor in getting good terms is leverage, and leverage comes from having multiple investors interested at the same time. When you have 3 investors competing for your deal, you can push back on aggressive terms because you have other options. When you have only 1 investor, they are probably going to know it and they're going to structure their deal in their favor because you don't have anything to push back with. So you definitely want to run a competitive process wherever you can, even if it means waiting a few extra weeks to generate more interest before signing anything. The next thing to watch out for is a tactic called the drag and drop. The way this works is an investor gives you a term sheet, and that term sheet will have exclusivity, which means you have to stop talking to other investors because of this exclusivity provision. And the investor drags out the process for weeks or months, your round goes cold, and your other investor conversations die out. Then the investor comes back and changes the terms or adds new clauses, and you have to accept because you have no alternatives left. The way to protect against this is to limit the exclusivity to 30 calendar days. If the investor doesn't close within 30 calendar days, assess, and if you need to, move on. The last part is bringing a lawyer in at the term sheet stage, not at the final document stage. A lot of founders try to handle the term sheets by themselves to save on legal fees, then bring a lawyer in when the full investment documents show up. But by that point, the economic terms, the board composition, the protective provisions, and the control terms are already locked in. So all a lawyer can do is review your paperwork and make sure it matches what you already agreed to. So get a lawyer involved the moment you get a term sheet in front of you, because a good venture lawyer knows exactly what's standard, what's aggressive, and what's a deal breaker. And I can tell you from being a venture lawyer myself that the cost of a lawyer at the term sheet stage is a tiny fraction of what bad terms will cost you at exit. So if you've got a term sheet in front of you right now, or you're expecting one soon, and you want to make sure you don't sign something that costs you millions at exit or costs you control of your company, click the first link in the description to book a free consultation with me. I've negotiated hundreds of these deals, so we can go through your term sheet line by line and figure out exactly what to push back on before you sign anything. So again, book your free consultation with me by clicking the first link below. And if you want to learn about what goes in your data room when raising for your startup, then check out this video next.